Today, we're going to be talking about the big lie that media has been pitching for years that real estate is the best investment for people. They should always be buying real estate and never renting. And it couldn't be further from the truth. We're going to dig into the graph that has been going viral on the internet and why that chart is so misleading and why the critics also have it wrong. So let's dig in. This is the chart that came out from the Wall Street Journal that has been going viral on social media, showing that stock performance is way stronger than the median US house price. This comes from the Federal Reserve and FactSet, and it looks like it goes back to 1970 and then charts those gains of the S&P 500 and the US median house price. Now, when you just look at this chart, you just say, okay, stocks for sure are an incredible investment, way better than buying a house. However, the reality is, and the trick, and I'll show why this trick exists and why the trick doesn't work, but the US median house price is often leveraged by 80%. Why? Or even more, because people get down payments of 5%, 10%, 20%, often that give them leveraged return on just the money that they put into their investment. And a lot of times people do not buy stocks on leverage, although they do buy options or they buy other types of assets that can be like a leveraged ETF to leverage their returns as well. However, for this comparison, we're just going to be talking about what an average consumer generally does, and we're going to make some assumptions. And let's see what happens to these numbers when you do actually take 80% leverage on a US median house price. What do the returns look like when you do that? So this chart obviously shows US housing 80% leverage. The blue line shows that a leveraged household purchase will outperform the S&P 500 from the same time period. And if you're unleveraged and you just buy it cash, of course, it's not leveraged, so it's not going to get as much of return. You're putting down a lot less money to be able to purchase that asset. However, this chart does not share the many nuances that come along with owning a home. It also does not include the fact that a lot of these S&P 500 indexes have a dividend yield. So let's dig into what it could actually look like when we adjust for all of the factors, because I think the experts are getting it wrong, the media is getting it wrong, and the people who originally say, well, stocks are just straight up better, are getting it wrong, because we need to take into account every little factor that goes into each one of these investments. So let's see what happens when we take into these factors. So yes, we're taking into account a 80% leverage, but you have to understand a house is a physical asset and it requires repairs and upgrades to keep up with other houses in the area. And that's why I can tell you for sure that stocks are an incredible investment when you take into account the repairs. And this even gives a 4% rental yield, assuming that you're renting it out. And if we add back in a 2% dividend rate into the S&P 500, which is normal, you can usually get a little bit more dividends. It shows that the craziest thing, stocks are way better of an investment than owning real estate, because the cost of real estate is a lot. As you know, your taxes, your insurance, your repair costs are all up more than 50% in the last 5 years. Yes, your housing price went up, but you now have all these other expenses that are creating an outflow from the asset that make it a lot more challenging. And right now, especially here in Florida and in Jacksonville, we're seeing rents drop 10 and 20% in some areas, with a bunch of people who are sitting on their vacant houses for months on end making no money, and it's just a stream of outflow. So they're actually losing money owning the investment. And as we always know, real estate does not always go up. I know a lot of people say, well, it always goes up on average if you hold forever, 4% per year. That couldn't be further from the truth when you look at it on an actual graph that shows the up and down of what prices do and how long it takes to get back. So let's dig into what really matters when buying real estate and what matters when buying stocks, because it's very different and very similar in different ways. So for real estate, number one, cash flow. For me, as a real estate investor, I've owned over 200 doors. I'm looking for at least $300 a door. Location, I'm looking for A-class locations. I don't want a condo or townhouse. I want single family house. Financing, I want to be able to put as little amount down, because you want those leveraged returns in an area that I think has a long-term growth trajectory with awesome demographics. And I think the condition is fantastic versus other Similar type of product, so that way it'll sell faster if I ever decide to sell. It needs to have tax efficiency, so I might be doing a cost segregation on it if it's a multifamily, maybe not if it's a single family because the cost doesn't make sense to do it. It's fine the way it is. I need to find a property manager to manage it, or I have to manage it myself. So these are decisions I have to make. And what's my exit strategy? Is this an asset that I'm going to hold forever until the end of time, or is it something where I'm going to wait until the price gets to a certain point and then flip it, sell it, 1031 it into something else? So I have to know these things. Generally, it'd be good to know these things before you go into the investment. These at least minimal aspects and what they matter for real estate. Now, what matters for stocks is you need to have a moat on your business. That means you need to be way ahead of the competition. They can't catch up with you. You have some sort of competitive advantage that they can't copy. The durability of the business. So if we go up and down through a recession in the business cycle, is it staying strong throughout those business cycles? Are the earnings really powerful? The returns good? Of course, valuation makes a big play. The balance sheet, how much cash do they have, the innovation and growth that company has, the management team that they have. Do they have the best management team? Are they reinvesting their cash flow in their business? Where's the cash flow going? Are they issuing dividends and giving money back to me as the investor? And then, of course, what's the risk management team look like? And what's the likelihood of the volatility of my earnings? This is what matters when you're looking at a stock investment. So they are different in different ways. And here's a great chart that kind of sums it up of what it kind of looks like, because there are similar nuances to each one from an investment standpoint, right? The core return of drivers for real estate investment is the cash flow and the appreciation that you get, right? So the equity growth and what you could rent it for, or what you do rent it for. Stock investments would be the earnings, the multiple expansion, the dividends, right? Leverage is how much are you doing, are you leveraging debt to be able to purchase the asset? So a lot of times for real estate investments, it's you got to put at least 25% down, 30% down. We call this the loan to value ratio, and it magnifies both your gains and losses, which is something that we're going to be talking about because it is not always a good idea to buy real estate on leverage if you buy it at the wrong time. Same thing with stock. Limited, usually you can get margin of 50%. Most returns come unlevered just through business growth. People just buy the stock outright. They don't get leverage, although there is a lot of leverage in the system right now. Valuation, right? So what you pay for it is really important. The cap rate, cash on cash return, the IRR, similar metrics for, stocks, the price to earnings ratio, price to free cash flow. Inflation hedges, I got to tell you right now, I do think that stocks are a better inflation hedge than real estate, especially in the South, because we have so much supply coming on. I actually think that we're going to see some deflation in real estate prices and in rent prices in the future. For stock investments, I think the Fed's going to cut rates, and I think we'll actually see higher stocks, especially tech stocks with high multiples, because that will push evaluations up the lower that the rates go. Liquidity, real estate isn't a liquid asset. It's hard to sell. You can't just wake up one day and be like, I want cash for this tomorrow, or else you're going to get a massive discount. Stocks are great because it's very liquid. You have instant trading and low friction. So you even study the real estate, the CFA books, they mention this all the time. Liquidity is not one of the number one factors for real estate investors. You need a liquidity premium. You need additional return from owning real estate because it's an illiquid asset. Control, you can have high control of your real estate investment. For stocks, you don't have control. You only own a little bit of the share and you can't decide the management decisions, but you can decide to sell. Taxes, it has depreciation shield 1031 exchange, which we talked about to defer capital gains. Obviously, if it's a primary residence, you get benefits there. For stock investments, you can get dividends, which are down to a 15% rate. Capital gains can be 20% rate. You can also use Roth and retirement accounts to shelter for taxes. Your risk profile, it's localized market risk, tenant risk, maintenance surprises, leverage risk, all these issues that real estate investments have. On the same side, stocks have market volatility, earnings risk, macro shock. So things that can pop up that can move the stock up and down quite rapidly. Now, real estate, because it's a liquid, it does not move so fast. It takes time for real estate to move. So that's why a lot of people say, well, there's a lot of these YouTubers out there that have been saying since 2022, real estate's going to have a, correction at least. Well, a lot of areas it's already corrected. And the reason why is because we saw interest rates go up, prices will come down, but it takes years for that to play out because it's in a liquid asset class. Maintenance and CapEx can go from 1% to 5% of the property value, just depends on the age of the asset and where it's located. Right? If it's closer to the ocean, obviously it's going to need more maintenance. Stock investment, none. This is the great part about stocks. The company reinvests for you, or you just don't have to worry about it. There's no maintenance. Compounding mechanics, right? You can rent reinvestment, you can have your appreciation, you can have your amortization pay down, right? The principal pay down on your loan. For stock investment, you have your dividend reinvestment, buybacks, and internal growth. Time horizon for real estate is typically 5 to 30 years. It's a liquid but steady. Stock investments could be 5 to 50 years. It's liquid and compounding friendly. Ideal investor for real estate is a hands-on operator, uses leverage, and values control and tax efficiency. For stock investment, it's patient capital allocator looking to scale, get diversification, and have liquidity in their portfolio. So they're very different investment vehicles. They're used to accomplish different things. However, they do have some similarities, which is the most important thing, which I want to talk to you about. But before we dig into that, I want to share with you who owns what, right? So the top 10% owns, you got it, 87% of stocks. So the wealthy prefer to simply own stocks in private businesses, and then they use real estate generally as a hedge to get depreciation against their ordinary income. Okay, that's what it's used for a lot of the times. Of course, it's great if you can buy at the right time, get the right leverage, right capital stack to also generate cash flow over the long term. But they own 67.3% of the total wealth. You can also see that the real estate, because the top 10% doesn't own it, a lot of other people, just regular people who are not in the top 10%, own a lot of real estate. And this is because they use it as their primary residence as a shelter. However, I can tell you this, the problem with real estate is that leverage is a double-edged sword, and it depends on when you buy. So let's say, for example, you bought and then there was a 20% drop in prices, a 30% drop in prices, or a 40% drop in prices, which has happened before, right? Here in Jacksonville, we saw a 36% decline within a few years after the great financial crisis. So look, you can see here, it would take, assuming a 2% growth rate, 11 years in price to recover. For 6 years at a 4% rate, and it would take 4 years at a 6% rate. Okay, so it could take a long time just to break even. If there's a 30% drop, it could be take you 17 years to break even after 2%, 9%, 9 years after 4%, and 6 years after 6%, 40% drop, which, by the way, is completely possible. I know a lot of people doubt that this is going to happen, though it is completely possible if we see some sort of yield spike in the 10-year treasury and in treasury rates and MBS at some point in time. If we see rates truly go to 10% at some point in the future and the Fed does not step in to fix it, of course, we could see this type of drop in the real estate market over a few years. It does not happen overnight. It happens over years because real estate isn't a liquid asset class. This would be 25 years at 2%, 13 years at 4%, and 9 years at 6%. So historically, like a decline of 2006 to 2012, if you had a 4% recovery every single year, it would take 10 to 13 years to return to those peak values, right? So again, leverage is a double-edged sword. If you put a lot of leverage in something and then it goes down, it's a problem. So what matters is when you buy. The time that you buy and the price that you pay are the two determining factors for real estate on what your returns are going to be. I bought real estate back in 2014 here in Jacksonville. I bought 2015, 16, 17, 18. I bought from foreclosure auction. I owned a bunch of real estate and I sold the majority of it, almost all of it in 22 and 23. And I'm very grateful that I did because the leverage to the downside would have been tremendous because prices are down 10 to 20% here in Jacksonville. And I made a ton of gains on the little amount of money that I put into my real estate. So I used leverage and it worked for me. Why did it work? Because I bought it at the right time in the right place, and I got these super low interest rates at the government. But if you were to buy that same asset or try to replicate what I did back during those years, that opportunity is no longer available. In fact, you're at extreme risk at buying at today's prices if you don't buy intelligently and get the right type of leverage on your asset. So it does not always make sense to simply just pick up and buy real estate. Now, look at this. This is if you consider the costs of buying and selling real estate. So I don't think a lot of sellers understand this and a lot of buyers don't understand this. It costs you about 6% to get in and it costs you about 6% to get out when you buy real estate. And repairs are very real. When you need that roof, you need that HVAC, you have a plumbing issue, etc. For the majority, if you're not buying new construction, which, by the way, some new construction have tons of issues already. Well, let's just assume a 5% repair rate. Well, and that's the case. If you're assuming 6% cost to buy, 6% to sell, the transaction friction is 12%. That's like tremendous. Okay. Now, if you also assume 5% annual repair and maintenance costs, which is on the high end, right? A lot of people say 3 to 4%. It just depends on the age of the property where it's located. Even with moderate appreciation, costs massively delay your recovery of owning real estate. At a 30% price drop at 4% annual appreciation, it can take 15 to 18 years to break even. Okay. That's crazy. At a 40% drop at a 2 to 4% growth rate, you might never fully recover because the repairs and maintenance might be so high. It creates not only a transaction drag, but the maintenance drag on your returns could be phenomenal. Okay. So there is a point where you will recover because your loan will pay off, but you might have to hold that investment the entire time until your loan pays off. So the reality is that real estate's break even is far slower in real cost adjusted terms. These costs are what drag you. It's just the same thing. Tony Robbins wrote a book, Money, about this, where you have your manager taking 2% of your money every single year and they end up with like 40% of your portfolio over 30 years. It's the same idea with these costs to maintain your asset. It will drag you down and it'll make your returns a lot less. And this is why a lot of people who invest who don't track the cost of repair end up being like, wow, I have all these assets. I didn't make as much as I thought I did at the end of the day. And it is a real problem. I do like real estate as an asset class. I own a lot of real estate. I've owned a lot of real estate. It's made me wealthy. However, you need to buy it at the right time in the right place, and you got to hold it for the long term so you can get that principal pay down. I think, and you need to be able to escrow correctly for the repairs that create that drag. Now, look, right now we're in the most unaffordable market in decades. Okay, so the buyers are completely priced out. Their median incomes are not staying up with what the cost is to actually afford a home. So you need about $111,000, $112,000 of a salary or income or dual income, etc., median household income to be able to purchase a house, and people are only making $84,000. So there's a massive gap on a relative basis of what people earn to the money that they need to actually purchase a house. This is going to slow transactions down, and this is just an indication that you are buying at one of the worst levels ever from an affordability standpoint in history. So if you're buying a house right now and you have those transaction costs and you have those maintenance costs, it's very unlikely that you're going to see great returns in the next few years. Of course, I hedge that by always saying it depends on what the Fed does. If they step in and try to reverse course, I don't think they're going to be able to bail out the real estate market this time, especially in the South where we're so overbuilt and the demand has slowed tremendously. And by the way, the demographics here do not look good, which is the silver tsunami and the immigration policies that we're seeing. It's really slowing housing down, and I think it's going to be a problem. If we get another couple of hurricanes here in Florida, it could really be a problem. But ultimately, what you want to take from this chart is that buyers are priced out. It's not that people don't want to own houses. It's that it's just so unaffordable for them to do so. And if they can't afford to do so, then how can prices continue to move up? This is leading us to a breaking point. This is the estimated number of U.S. home buyers and sellers actively in the housing market. It comes from Resi Club. I believe it came from Redfin. Yeah, Redfin in June 2025 showed that there's more than 500,000 more sellers than there are buyers right now in today's market. And I believe this chart should actually be going up even more. There's even more sellers than that than there are buyers as we continue to look forward at a pretty stark future for the housing market when you have so many sellers continue to prop up, and we have all these loan loss mitigation programs rolling off from the FHA programs becoming more difficult to achieve, lumping your missed payment onto the back end of your loan. It's going to be a problem, moving into Q2 of next year. We expect to see a lot more many issues come up in the housing market between Q2 and Q3 of next year is what we're seeing. Now, because there was a period of time where we had a lot of sellers who refinanced their home when the rates went to basically zero, it caused this lock-in effect. Why would I sell my house when I have the lowest mortgage rate we've ever had in history? So this is causing only 11% moved in 2024. This is the lowest mobility rate on record. So many people are trapped in their homes and they're unwilling to trade their low mortgage rate for a higher mortgage rate and move somewhere else. So we are seeing transactions slow down because of this mobility rate. And because it's slowing down, that means that we're going to have a lot of people who are just going to stay in their homes longer, and that means less transactions. It's going to slow down the price appreciation of houses in a lot of cases because they're still overbuilt in a lot of these areas. And so demand is supposed to transfer from house to house. This is a problem if you're a real estate agent, definitely, or if you're a seller looking to move. You're going to have less options to choose from on one end from other people who are also staying in their house. But you're also going to see prices, probably come down in the future because of the new construction that's being built. We're not seeing these issues in the north, in the northeast. We're seeing them generally in the south, where you're seeing a lot of new construction offer great interest rates in upgraded properties. So this is a crazy chart. This just says the motivated seller index by county. The higher values indicate a greater homeowner urgency to sell. So homeowners in the lower half of the U.S., also known as the Sun Belt, are the most desperate in the country. In Denver, Charlotte, Jacksonville, smattering other Sun Belt markets, more than half of the homes for sale have seen a price cut. This is true. This is what we're already starting to see. So transactions have slowed down. There's a lot of new construction competing. Existing homeowners are slashing their prices and builders are slashing their prices. We're seeing rents come down. So if you're an investor and you're in these areas, you are getting crushed right now. And the vacancy rates are also starting to move up. And we're going to continue to see this happen going into next year. And there's really nothing that I can see that would change the direction in the short term because the demographics and the relocations are not looking so good. And frankly, we need a healthy reset in the market to be able to get to the other side of this and start seeing appreciation happen again. But again, if you're buying right now, leverage at the wrong time, you could really be in trouble. A lot of the trouble that we're seeing is this leverage in new construction communities where the price of the house is really high and the buyer's only putting down 3.5%, has not a great credit score, or a VA, and putting 0% down. And now the market's going down and they're completely underwater and they're coming back 2 years later. Hey, I want to sell this asset. It depends on the vintage year of what they bought, right? If they bought their house in 22, 23, 24, they're underwater. But if they bought in 2019, they should be okay. If they bought in 2020, they should be okay. So when you buy, in the rate that you get and the debt that you get and the carrying costs of your asset is going to determine almost every other factor. So you need to be careful. It does not make the same sense to buy today as it did in 2020. And that's what you need to take away from this video. Now, where we're seeing the most issues, again, it's Florida and Texas. You can see that Florida and Texas have this housing inventory surge that's happening. Sellers are locked in at 3 to 4% in their houses. The buyers are completely priced out because the prices went up so much, and the inventory is moving up because of new construction competing with existing homes. And so the next logical step is that prices really need to come down. And again, it's the story of two different markets here. The Northeast inventory remains tight because they didn't have that speculation and they didn't have the overbuilding that the Florida and Texas market inventories have. So look, do you think real estate is the best investment, or does it only make sense to buy real estate at the right time? Because I hear a lot of people say out there, you just need to hold forever, buy and hold forever. Does this make sense? Does buying and holding forever make sense? And does it make sense when you're comparing it against stocks? Because there is a lot of that drag from the repairs and maintenance that have to go with the real estate and the active management, whereas you could just buy a stock you think will be doing well for the next 30 years, and the multiples for stocks are extremely high versus owning real estate. So I'd love to hear, what do you think? Are you a real estate forever type of person, or are you real estate, hey, it only makes real estate when it makes sense? Or are you buy and hold forever type of person? Let us know down in the comments. I'd love to hear from you. You guys already know what I think. Timing is everything. And the future is not bright for real estate in the South over the next few years based on the data that we're looking at. If anything changes, we will let you know. As always, you can subscribe to my Substack down below. I talk about things I can't talk about here on YouTube, and I'd love to connect with you further. Talk to you soon.